But you go from owning real estate, property management company or not, active real estate, having your hands on the job, to essentially owning a private real estate investment where you're just collecting a paycheck, and then you continue deferring the taxes out into the future indefinitely.
Welcome back to the Retirement Fiduciary Podcast, a place where we have authentic, no BS discussions about retirement planning, investment strategies, and wealth management. Whether you're approaching retirement or if you've already made work optional, this show is for you. Now, here's your host, Adam Koós, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group at libertaswealth.com.
Hey everyone, welcome back to the Retirement Fiduciary Podcast. This is a conversation from a podcast that I was featured on recently, and we're just excited to share it with you here. In this discussion, we talk about fiduciary responsibility, business ownership, and the importance of planning ahead instead of reacting, all topics that align closely with the work that we do and the conversations we have with clients every single day at our office. If you care about understanding the why behind financial advice and making more informed, long-term decisions, I think you're going to find a lot of value in this episode. If you'd like to get a second opinion, or even if you just want to see if you're a good fit for us at Libertas Wealth, just head over to our website at libertaswealth.com, and you can also find that information in the show notes. Otherwise, please enjoy my conversation with Sharad Mehta.
Hey guys, this is Sharad with Recently, host of the Recently podcast, bringing you another very special guest, Adam Koós, on this podcast. Adam, welcome to the show. How are you?
Well, thanks so much for having me. This is going to be fun.
Yeah, absolutely, Adam. Yeah, tell us a little bit about yourself, where you're joining in from, and what is it that you do?
I'm hailing from Columbus, Ohio, grew up in Cleveland, went to Ohio State University and stuck here like a lot of people do when they move to Columbus and go to school here. So I went to school, technically, I went to school to go to med school. I wanted to be a trauma surgeon. So I was pre-med until my senior year, and then kind of had, a big kind of life-altering moment where I just decided I didn't want to go to school for 7 more years. And I called my dad, who was an optometrist, and I thought he was going to kill me. I thought that, I told him I'm going to drop out of the program. And it turns out he says, well, what are you going to do instead? And I was like, I don't know what I'm going to do. And he says, well, what about being a financial advisor? I'm thinking, Dad, you got to be kidding me. Like, I don't know anything about econ. You know what I mean? I took one econ class. He says, yeah, but you're good with people, and you're a smart guy, and you've got that virtual stock exchange account you're always messing around with. So he's like, I'm sure you'd be really good at it. And he introduced me to his financial advisor, and then still wasn't so sure. Guy told me to come down to Columbus and go to a seminar and basically, tell him if I was interested, and they would go through the hiring process, and if not, just not call him. So long story short, I went to this seminar. I found out that my biggest concerns about this industry were the ethics, or lack thereof, I should say. The firm that was hiring me was basically going to let me work from home for 9 months or so until I was able to be profitable, after which they would put me in an office, and I wouldn't have, like a sales floor, so to speak, of people that are, you think of the movies like Wolf of Wall Street, Boiler Room, movies like that. I just didn't, that was my image of the industry. And so being able to kind of start in a somewhat monogamous, autonomous office environment, and then I ended up starting my company in 2004, November 4th, 2004. Just because I wanted to get away from all the conflicts of interest that exist in this industry, in this world. So I've been running an RIA, registered investment advisory firm. We're fee-only fiduciaries. And we pretty much help 2 groups of people. One would be individuals and couples, typically working professionals. I was just telling somebody yesterday, I don't have a single wealthy client that doesn't own some real estate. So I'm sure that rings true with you as well. And then the other group of people we work with are business owners, where we help them, increase their enterprise value, increase profits, efficiency, get them out of the business to a certain extent, de-risk, create continuity, and then essentially get their business ready for sale at some point, and then manage the assets thereafter. So that's kind of in a nutshell what we do. So we're basically an investment management and financial planning firm that works with owners and working professionals.
Awesome. First of all, amazing dad, super supportive dad there.
Yeah.
Just say like, yeah, I'm going to drop.
Pretty lucky, huh?
Like, yeah, no, that's amazing. Yeah, I come from an accounting background. I used to be an accountant. So at one point when I was at my accounting job, I wanted to be a CFP, which is Certified Financial Planner. What are the other 2 certifications you have, CMT and CEPA?
Well, they're not all on there actually, because I think that at a
Oh, they're
certain point
not.
it starts to look pretty silly. You almost start to look like you have a complex if you put too many designations after your name.
So you put the
But
most important ones. Yeah.
yeah, the ones that are most recognizable anyway. So
Yeah.
the CFP, most people know what that is. The CMT is a Chartered Market Technician designation. It's the sister designation to the CFA. So this Chartered Financial Analyst designation is all about fundamentals. The CMT, Chartered Market Technician designation, is all about technicals. So it's technical analysis, momentum, trend, volume, things like that. So technical indicators. And then the CEPA is the Chartered Exit Planning Advisor. So this kind of goes along with our work we do with business owners, helping them grow, sell, transition. Doesn't have to be selling, but just helping them grow and get more efficient. So that's the CEPA. And then there's the Certified Financial Technician one, which again, I don't list it because it's kind of like the CEPA. So the kind of
Okay.
little redundancy there.
Yeah, but you're overachiever. You wanted to get
Yeah,
that too.
yeah. Just to
Yeah.
have a complex, right? Yeah.
Yeah, that's the first person I've seen. I've seen, like CFP is the most common one, the CMT, CPA, and the CFD. Yeah, you're the first
Yeah.
person. So yeah, congratulations on all
Oh,
that.
thank you. Yeah, I just like
Yeah.
to learn.
Yeah, no, that's great. So you said pretty much all high net worth individual that you work with own real estate, right?
Most of them. I wouldn't say all because that'd
Most
be
of
a
them.
pretty big
Yeah.
number, but most. Yeah, I mean,
Yeah,
most
most of
people
them.
want to diversify into real estate.
We have a lot of listeners that are doing fix and flip, wholesaling properties, and own rental properties,
Yeah.
right? What is some advice that you like to give to real estate investors? Because you don't need any credentials to become a real estate investor, right? You see
Mhm.
someone doing well, there's very low barrier to entry. And people don't always think about their taxes, their finances once they get into the business, right? You're
Yeah.
nodding. So what are some of the, first of all, what are some of the biggest mistakes you see investors make with their financial planning?
If we start with real estate, I got a whole list of things that people make mistakes with financial planning. But if we just stick to real estate for starters, I would think the first would be just to always manage risk. In fact, that's something we do when it comes to portfolio management and technical analysis. It's like it should be the same in real estate investing. If it doesn't feel good, don't do it. You have to start with managing risk. Start. I don't want to say with an exit strategy, but you really have to manage risk from the start because you can blow yourself up. I'm sure you've heard your own fair share of stories of people just going in too hard, too much, too leveraged, and it just doesn't work out for fix and flips. Where the budget gets out of hand. You got to be. There's always a certain level, I think, of uncertainty when it comes to how much is this going to cost, how long is it going to take. But I think we all know that oftentimes it doesn't usually happen faster and for less,
Right.
right? It's usually slower and for more. So I think the first thing is
100%.
just managing risk. Making sure you go in there with a good plan, have a spreadsheet built out, know exactly what your numbers look like and what your margin of error is, and how much wiggle room you have, or guardrails, as we like to say. You got to have some room to screw up. Had to have I'll call it like a sunk fund. A line on the spreadsheet that's literally for what if this doesn't work out
Right.
like we think it will. So that would be probably the first one, and then the second one, you already hit it actually, and this is huge, is people just not getting their taxes handled early on, and that can turn into quite a mess. And it's
Yeah.
not unlike credit card debt, where you get behind on credit card debt, and all of a sudden you find yourself having a hard time getting out of that hole, let alone getting to a point where you're in the black and saving and really making forward progress in your financial life. So I think the other big one when it comes to real estate investors specifically would be, get those quarterly estimates done early, stay on top of your tax situation, because it's really enticing to want to take that profit, that cash flow, and spend it. Or, if you might even consider yourself to be really responsible and you say, I'm not even spending the money, I'm just reinvesting it in another property. And that's fine. But if you're not paying the taxes, the IRS doesn't like people who don't pay their taxes.
Yeah. That's something, to be honest, Adam. I've struggled it for a long time. This is, I think, the first year where I made my quarterly tax payments. It definitely hits your cash flow, but it feels so good to just know that, okay, I've set my taxes aside and I don't have to worry about it. Otherwise, it's a pretty big, if you're not paying your, especially as a business owner, if you're not paying your quarterly taxes, it's a pretty big hit at the end of the year when you do
Huge.
your tax return. Yeah.
Yep.
And then plus the interest and penalty not to speak of that. And then, I don't know, it's just my theory, then it raises a red flag with IRS that you're not paying your taxes, quarterly taxes, so you may raise an order file. But that's just my theory. And maybe I just tell myself just to force myself to pay those quarterly taxes. But
Oh,
one
you're
question
right.
I have is this. So I own about 60 rental units, right? A little over 60. Most of them are paid for free and clear.
That's
I
awesome.
own most
Congrats,
of,
by the way.
Oh, thank you. I own a property management company and I flip houses, plus I own the software company. For specific to real estate, we have investors listening that own rental properties. What is their long-term exit that you see? Is that, let's say if I have 30 residential properties, right? Is the best option for me down the road if my kids don't want to be landlords, if they don't want to do anything with the real estate, is my best option down the road is to individually sell them? And if that's the case, like, how do you help people manage that? Like, guide them to make sure they're being as efficient, getting the most bang for the buck?
Yeah, sure. That's a great question. And by the way, it doesn't matter if you have one property, three properties, or 30. It's the same regardless. It's just a matter of how complex we want to get when it comes to what we buy and how much we buy or how many. A very not so well known strategy that's out there available to anybody who is a residential or commercial real estate investor is everybody sort of a 1031, right? I mean, most people know what that is. Buy a like-kind property, avoid the capital gains tax. But that's the problem, is the capital gains tax. Most people who have been successful in real estate, and obviously this compounds over time. So eventually you find yourself with all this low basis and these appreciated properties and then taxable income on top of that, which, I don't think we care too much about the taxable income, but it's the appreciation that's the problem. It's sometimes even if you have a property management company handling all the property management for you, or in your case, you own a property management company, I think it can still start to feel at a certain point when you're done working, if you have another job, like a full-time job, I think it can start to feel like you're never retired. There's hassles. They say that, the terrible T's, right? Toilets, tenants, trash. And eventually, maybe you just aren't interested in owning these properties anymore. You'd rather take the profit, redistribute it into another kind of portfolio or diversified portfolio elsewhere in a different way, non-qualified, call it brokerage account, whatever. Or maybe your kids don't want it. Like you said, maybe you're getting older and you're to a point where, like, man, I'm thinking about my estate planning, but again, I don't want to sell these because I don't want to pay the tax. The trick, or the secret that's out there that's not so well known, is something called a 1031 into a DST, which stands for Delaware Statutory Trust. The way these DSTs work is, unlike owning real estate, whether you have a property management company or not, where you're managing the real estate, I call that active real estate ownership. So in other words, as an active and real estate investor, you own physical property. You can drive up, touch the wall. It's yours. You own it. You deal with the tenants and so on and so forth. Passive real estate investing would be, it's not that you can't go touch it, but what you would do, let's just say hypothetically, you've got 30 properties. You start selling these properties off, and then you use the 1031 rules to your advantage to buy a passive piece of real estate managed by another company, where you just benefit from the yield. So we'll call it 3 to 4% per year, and plus the appreciation on top of that. But you don't have to pay taxes on it, and you don't have to hire a property management firm because it's already taken care of. So examples of these could be multifamily. It could be warehouses. It could be storage units. It could be medical facilities. So you're basically a fractional owner. You become a fractional owner of that real estate, and thereby avoiding the capital gains. Now, usually these things do liquidate, at a certain point, whether that be 5 years, 7 years, 10 years, they end up liquidating. It's time to sell. And when they decide it's time to sell, you're going to sell. And so the next question usually is, well, when they sell, don't I have to pay the cap gains then? And the answer is yes, unless you 1031 it again. So you can continue 1031ing these DSTs over and over again until you pass. And when you pass away, it steps up in basis. So now all of a sudden it's tax-free to the kids, or charities for that matter, which obviously charities don't pay tax. But that's essentially in a nutshell how it works, how the strategy works. It's obviously a lot more complicated than that. But, that's why we use, third-party administrators to help with the 1031 process, escrowing, things of that nature, and make sure we're doing it legally and in a way that's not going to cause us any problems on the back end. But you go from owning real estate, property management company or not, active real estate, having your hands on the job, to essentially owning a private real estate investment where you're just collecting a paycheck, and then you continue deferring the taxes out into the future indefinitely.
So it would have to be as a 1031. But my first question is, can I do 1031 of, like, if I have 30 properties, can I do each one separately, or does it
Yes.
have to be a package? So it doesn't
That's a
matter.
good question. Yeah.
Yeah.
If you think about it, like if somebody has one property, they can just do one property. That's all they have.
Right.
If they have three properties, where it gets where I think that your question comes into play is, in your case, if you've got 30 properties, there's no way we're going to sell 30 properties and buy one DST. You're going to have to buy a few. Not to say that you couldn't be the majority owner of a hospital system, a hospital in here in Dublin, Ohio, let's just say. But chances are you're probably going to have a few properties, if not several, that you're fractional owner of.
Okay. And then for 1031, just for anyone that's not familiar with it, if you can just give a little bit, background on kind of how that works. You sell a property that you have to own for a minimum of 1 year. Is that the requirement?
Mhm.
Right. And then you sell it. And then it's within 6 months, if you invest the funds in another real estate
Like kind of
property,
real estate. Yep.
like kind real estate. So in this case, you take the money and you put it in a DST,
Hmm.
right? And then through the DST, you're investing in other properties,
Yep. Real estate,
right?
whether it be
Real-
residential or commercial.
For me, could I do lending out of it, or it has to be piece of property that I have to own through this, or is there
Are you
something
are
creative
you
I can
saying could
do?
you 1031 into say like mezzanine debt? Is that what you're asking? Like as an example?
Yeah, exactly. Or is something creative I can do to get a little bit higher yield? I have
I
I have
see.
investors that sometimes would come to me and say, "Hey, can you lend on this property, for example?"
Yeah, I mean,
Yeah.
I'd have to check on that. I've never been asked that question before. I mean, I do know that there's investments out there where you're literally investing in debt. The yield is higher. I just don't think we can 1031 into it because it
Got it.
technically wouldn't be real estate. It would be debt on real estate. Higher risk, obviously, which is why you get the higher reward. But there's also I mentioned 3 to 4% because I'm trying to be conservative and reasonable and, set good expectations here. But, there's lots of different options out there and some pay higher yields than others. Just depends on the type of property, where it is, the old location thing.
Right.
But yeah.
Let's say I sell my property, I put it in a DST and invest in, let's say, a hospital, and I'm getting, let's say, 4 or 5% return on that.
Mhm.
I'm paying taxes on that 4 or 5% return, or is that also, so I'm just paying taxes on the active income that's coming in, but not on
Correct.
the appreciation. So I basically, once I do 1031, I've stepped up my base on that, correct? And
Well,
as
when you
long
do
as
the
I keep doing,
1031, you still retain the old basis. So the old
okay, you
basis
still
still
retain the,
exists.
yeah, okay,
The tax savings comes at the end when you're gone. It'd be
okay,
exactly the same as if you held the 30 properties until you passed away. All of those would step up in basis as well. The downside is either A, you might not want to own 30 properties and manage 30 properties until you're
right,
85 or 90, or worse, I don't know that your beneficiaries, whether that's kids, sisters, brothers, whoever, want to manage 30 properties and deal with that when you're gone. So that's where I think that's usually
got
the
it.
bigger issue.
Right. Okay, that makes sense. Yeah. One question I want to ask you is because this is something I'm going through literally right now. This morning, I was looking at some Vanguard funds to invest in. What do you recommend for real estate investors, especially or business owners? Typically what happens is as a business owner, you get so optimistic about your business that you almost like put all your eggs in that one basket, right? You don't think about diversification. I was looking at my net worth. I think I have like 90% of that in real estate. And I was thinking, wow, I need to like diversify, put it in some funds. Is there like, ideal asset allocation that you'd recommend business owners or real estate investors to follow?
I mean, I don't know that there's any, magic pie chart, if you will. I think that when you're somebody who has done very well for yourself, it doesn't matter if you're a business owner or not, but business owners would typically be included there, assuming their business is successful, of course. But I think that when you do well for yourself and you save well and you're responsible, I think that earns you the right to own and diversify into things like real estate, not to diminish what, investing, through the stocks, bonds, commodities, currencies, whatever, not to diminish all that. But I mean, it's pretty easy to buy a stock, right? I mean, you go online, you open up an account and you hit buy 100 shares of Nvidia and you've got 100 shares of Nvidia. Pretty easy, right? If
Right.
you don't want to do it anymore, you want to sell it, then you hit the sell button, you transfer the money to your account and you're done. Real estate's a whole lot different, right? I mean, there's a bigger commitment. You got to be more careful. It's not as liquid. You're not going to go on your 30th investment property. You're not going to go selling the master bedroom to free up some cash for yourself. You can't exactly do that.
Right.
So, whereas in a traditional, portfolio of stocks, bonds, real estate, commodities, and so on, you can just hit the sell button. So, I think that as you become more and more successful, you earn the right to invest in things like real estate, hard assets. And then, but otherwise, I mean, the statistics go like this: average business owner has 80% of their net worth tied up in their company, and that's typical. So I
Wow.
don't think we should feel bad about that because usually our most valuable asset is the baby that we're growing, right? The trick there is to make sure that that baby's growing efficiently and that that's going to provide you with what you need so you can quit someday. And or as I like to say, make work optional. Not that you have to quit, but to have the choice to quit, to have a plan in place to make sure that when buyers look at your business, that they're looking at it from a place where, okay, this is a business I'd want to buy. This is something I'd pay top dollar for because it's ready to sell. And the sad truth is that most businesses just aren't ready to sell. In fact, more than 80% of businesses never sell. They dissolve. They go out of business. And then
Why is that?
75% of those 20% that do sell, those sell for less than market value. So it's pretty sad, the
Hmm.
statistics.
But why do you see, like, what are some of the reasons you see that the business owners are not able to get to that point of 25% off the 20%?
I'm so glad that you asked that question. So the ones that don't sell and the ones that sell for below market value, the answers are almost the same. For the ones that don't sell at all, it's because number one, business owners will wait and wait and wait and wait. They'll be 75 years old and you're saying, hey, when are you going to retire? Like, oh, I'm going to probably next year, or year after. And they just don't. And then they end up passing away. And whoever the spouse is or the kids, they don't have the acumen or the experience to run the business, so they have to liquidate. There's nothing to do. It just goes under. Another reason is disabilities. If people get disabled, they can't run it anymore. And another would be, cancer, dementia, Parkinson's. So, different types of diseases come into play.
Interesting.
Word gets out, that, hey, so and so, is looking to sell their business. It's like, oh, by the way, they've got cancer, by the way, just so you know. It's like all of a sudden it becomes a fire sale if it sells at all. And then when it comes to the very large number of businesses that sell for below market value, there's a number of reasons why they sell for below market value. One of them is not having any kind of retention set up with management and directors. So people who are key employees not having an, if there's no, I don't want to call it golden handcuffs, but if there's not some kind of retention in place, whether that be through bonuses, salaries, contracts, and the buyer comes in and all the management leaves, I mean, they're going to know that before they buy. That's the first thing. Second would be customer concentration. So a business that has, so let's just say, I don't know, 35% of their business of their revenue is their top 5 clients. That would be bad. It's still money,
Right.
and maybe they're good clients, but that would lead into that maybe those top 5 clients might have a great relationship with the owner, and when the owner's gone, now maybe those clients don't stick around as much if they stick around at all, and then that leads me to running a business where the owner's not so involved. And unfortunately, us owners, we love our businesses. We love our, growing this baby. So, we don't want to be uninvolved. But in order to build a scalable, profitable, efficient business, you have to run a company where you're not the main focus. You're not the show. You're not on stage. So another reason is the owner's too involved. There's no, like I mentioned, continuity. Customer concentration is big. Bad books.
Hmm.
People, you and I both, we own businesses and we pay for a lot of things through the business, whether that be, meals and entertainment, maybe a car, things like that. And those things don't exist in the buyer's eyes. And you have to do this practice called recasting to get those things out of the business and get it ready for sale and make sure the books look good. And most people don't do that. They don't even think about it. They don't even know they're supposed to.
Interesting. Wow. I would have not guessed those would be some of the reasons why, and
Yeah.
the number would be so high. How do you know that, you help businesses with exiting? Like, how do you know the business, it's the right time for an owner to sell?
I think a lot of whether or not the business is ready to sell has to do with the owner and whether or not the owner's ready to sell. That's probably the first thing. It's a very emotional thing to start and grow a business and then find yourself, on the other side of the equation going, now what am I going to do? I was working 50, 60 hours a week on this thing and now what? So I think it's really key to have a plan for what life looks like after the business, or I always call it life after football, because I'm sure you've seen the statistics about
Right.
professional athletes and
Yeah.
how once they're done at say 28 years of age or 26 years of age, they're like, oh my God, I've got another 50, 60, 70 years left to live. And I don't know what to do with my life. And they get depressed and, that becomes a problem. So it's similar with business owners. They've got to be emotionally ready. And I think that's where the financial planning comes in, where you were asking earlier about mistakes people make with financial planning is a financial plan, a written comprehensive financial plan has to be part of the equation here. In fact, when we do our business transition planning, it's step 3 and 4 of our 12-step process is doing a plan for the owner and the spouse. Because that plan is going to tell us, what do you need to have? Where do you need to be? What's your number? at the age at which you'd like to have the choice to make work optional. And we need to make the assets that you own, whether that be real estate, stocks, bonds, the business itself, it needs to be worth whatever that number is conservatively. Otherwise, it's not going to happen. So, we often have to pull levers, make changes, diversify, as you were putting it earlier. If somebody's really, really real estate heavy, I think it makes a lot of sense to have a portion of their assets invested in other things because, as goes the market. When I say the market, I'll say the markets, plural.
Yeah.
There's times when real estate does great and traditional stocks don't, and there's other times when stocks do great and real estate doesn't. So you don't want to have all your money on one train track. And then I think that when you're looking at owners and planning for later, the other half of the equation, aside from them being emotionally ready to sell, is having all those things in place, both having their books tight, having their customer concentration taken care of, having continuity put in place, business continuity for the owner. That's buy-sell agreements in place, retention bonuses set up for the managers or key employees. And all of these things can help grow your company today, make it more efficient, reduce the risk to a potential buyer and yourself, by the way. But it can also make work a whole lot more fun. You feel so much more free, and you won't feel like you're tied to the business all the time. Because I think we all go through a period from time to time where it's fun most of the time, but then there's some moments where like, man, I just can't get out from under this pile, and that's because we're
Right.
probably too involved.
Yeah. And I feel like, I know it's been a challenge with me, kind of that's something that resonates with you. Like as a business owner, your identity gets attached to your business. I think that's where like a lot of business owners struggle with is, hey, this is who I am. This is what people know me for, as this guy or that guy. Like I'm going to lose my identity if I sell the business. So
Yeah.
yeah, I can't, like, I haven't sold any business, but I can totally imagine what a painful process it would be to go through
Very
that.
emotional.
Yeah,
And
very
being
emotional.
told by somebody like me that there's problems with your business. It's like
Oh
a
yeah.
friend of mine wrote a book. He called "Your Baby's Ugly" is the name of the book. And
Oh wow.
it's all about this,
Yeah,
and it's like nobody wants to be told that their baby's ugly, right?
absolutely. Yeah, no, it's funny that when I started recently, it's a software product. I sat on it for about a couple of years before I opened it up for other people, just because of exactly the same thing. I didn't want people to criticize and say it's a, piece of crap.
I love it.
But at some point, you just have to have that courage to say, all right, let's just take it out in the open. If people say baby's ugly, then, we'll figure out what do we need to do at that point. But I totally understand it was such a painful process.
I had a mentor
Is there,
tell me once that
yeah.
when you do something different, when you basically become a trendsetter or you innovate and you stick your head above the crowd, you better be ready to catch some tomatoes to the face.
Oh,
And that's just kind of how
100%.
it goes, right?
Yeah, 100%. Yeah, you just something you have to like it. Just this past weekend, we released an update, which it just, it's taking a product moving forward. People are so used to how, our product worked previously. And now they're like, oh, I don't like how it works, and just something like, yeah, this is something you have to get used to. As another business, I was talking to my property manager the other day. So we have two people that we serve, the tenants and the owners. I think it's only one of the businesses that I can think of. Like both people that you're serving are always unhappy with what you're doing. Just the tenants are never happy, the owners are never happy. It's just the kind of business that
That's
property
funny.
management is. Yeah. With exiting the business, I 100% agree that having a plan of what you want to do after retirement or after selling your business, it's so great. Even when someone is like, working in a job and then they retire, if you don't have a plan afterwards, a financial plan and an emotional plan, like what are you going to do with your time? It's
Right.
such a struggle. Like it sounds very exciting. I'm just going to go sit at the beach, but it's not. Like, what are you going to do at the beach? How long can you
Right.
just sit at the beach and watch the waves come in and go back out? I don't know.
Yeah.
Yeah.
No, you're right. We
Yeah.
had somebody who was they said when we were going through the planning process, he said, what are you going to do after you're done? And what's going to keep you busy and keep you stimulated? Like this thing's been keeping you stimulated for 50, 60 hours a week, for what, 35 years. And he says, well, we've been really looking at building this our dream home, our dream vacation home down in Scottsdale. So, that's the plan. I'm like, well, what are you going to do there? And he goes, well, hang out at the home in Scottsdale. I'm like, but
Oh
what
yeah,
are you? I mean, what hobbies do you have? What are you going to spend your time on? You can't go from 60 to 0. We can only sleep so much, and I think most of us entrepreneurs don't sleep that much to begin with. I know. I put in about 6 hours a night, and I'm good to go. But yeah,
absolutely.
nothing to do. I
Yeah.
don't want to say nothing to do all day. You have to have something to do.
Oh, 100%. Yeah, I've started playing pickleball lately.
That's the
So
new
yeah,
rage, right?
that's the new rage. Yeah, everybody's talking about that. Yeah, I love it. I'm kind of hooked to it. I have a league
That's
that I'm
awesome.
playing in tonight. Yeah. Yeah, speaking of pickleball and how fun it is.
That's our segue. Our
Yeah.
pickleball's our segue.
No, not pickle.
Okay, let's
What
go.
do you do for fun?
Well, God, I play. My wife and I have been playing sand volleyball year round. There's an indoor sand volleyball place near us,
Oh, really?
and for
Oh, that
18
sounds like a
years
lot
we've
of
been
fun.
playing every Thursday
Yeah.
night. We play. We're like the average age of our team now is like 45 or 46. So
Okay.
we keep joking we're to change our team name to Everything Hurts because everybody else is so much younger
Oh,
and
yeah.
faster than us. But
Yeah.
we do that. I love football, so I'm a big Browns fan, Ohio State Buckeyes, football fan.
You have
I
to be living in Columbus, I guess.
Oh yeah, for sure.
Yeah.
Yeah, it's kind of a religion here. And then I don't know. It's like yesterday's a perfect day. This doesn't happen enough here, and I know in San Diego it doesn't happen either for different reasons. But just yesterday, a storm came through and temperature dropped, and it starts pouring and thundering and lightning. And I love going outside, sitting in a chair, and just sitting and enjoying
Oh
the
my God.
nature
Adam,
and
you
the
and me,
storm.
I love that. I miss that so much. I used to live in Canada and Chicago, and I miss so much like that, those storms about Chicago and Canada where I live.
They're
Yeah.
awesome. I love That's
Yeah.
probably one of my favorite things in the world, but, in San Diego, all you guys get is the marine layer that everybody complains about, right? "Oh, the marine layer, what are we gonna do?
Yeah.
The marine layer is coming," but
Yeah.
but it's
Yeah, I
beautiful, right?
know.
I mean, I'm
It
I'm
is.
I'm
It is.
making
I mean,
fun of it because 'cause I'm jealous.
I'm looking out my window. There's not even one cloud now. It's
I'm
just
sure.
clear blue sky.
It's
Yeah.
not
It's
even a
beautiful.
Simpsons commercial, right? The Simpsons with the
Yeah.
big puffy white clouds, you don't
Yeah.
even have
Oh,
that.
no, not even that. Not even that. Right, Adam. What's the one book that has had the biggest impact in your life? It could be a business book, it could be a personal book, or it could be one of each.
I'll give you 2. The one that made the biggest impact in my business life was Think and Grow Rich, Napoleon Hill.
Okay. Yep. That's a
And the
classic.
one that made the biggest impact in my personal life and business, but I'll say both, is The Four Agreements. It's a
Or
very,
again,
very,
what?
very, very short book. I listen to books. I don't read them. I don't know why it is. I can't read and pay attention, but I can listen and pay attention. But The Four Agreements is very short. If you listen to it, it's a 4.5 hour book. I literally read it once a year, and it's just all about how to be a better person. It's the added. It's not literally about the attitude quote where 90% of life is how you react to things, 10% is how what happens to you. But it's essentially things like first of all, don't ever assume anything about anything or anyone. Don't make any
Yeah.
assumptions. That's one of the four agreements. And it's a life changing book. It's really really cool.
Or agreements. I'll definitely check it out. Yeah. Yeah, I'm the same way. I prefer listening to books because I can just be in my car,
Yep,
listen to Audible. It's just so convenient. And you get through books
awesome.
much faster that way.
I agree.
Um,
Yeah, take notes too.
but
You can take notes.
yeah, absolutely. All right. Final question. If you could spend a day with someone, dead or alive, who would you want to spend the day with and why?
I feel like I should have a better answer than I'm going to give you, but for whatever reason, my whole life, I've always loved, not my whole life, my whole adult life, I've always loved Jet Li, the martial
Jet
artist,
Li. Okay. Yeah,
he's in
that's
all
a
the
great
martial arts
answer.
movies. I was on the Taekwondo team at Ohio State for years back in college, and he was like my
Amazing.
hero in the martial arts world. So I'll give you 2 then. I would say Jet Li it would just be amazing to hear his story. He's just a wise person, a good Buddhist person. And then the other person would be my dad. I mean, I see him a lot, but I'd like to see him more, so I'd spend a whole day with my dad all day.
Great answers. Great answers, Adam. All right, Adam. If someone wants to connect with you, learn more about your services, what's the best way for them to do that?
Yeah, best 2 places to go if you're an individual or a couple, and, I guess, or a business owner looking for knowledge, free advice, the good education. You can check out libertaswealth.com. You'll find not only all kinds of stuff in there from articles to screencasts, but we also have a podcast called the Retirement Fiduciary, which I believe, Sharad, you're going to be on here in the
Awesome.
not too distant future. So we're going to be doing a home and home here. I'm on
All
yours
right.
this time. You're on mine next time.
Looking forward to it.
Um, The other one for business owners only. So if you're a business owner and you're interested or at least intrigued about this whole exit planning, business transition planning thing that we've been talking about today, then check out elevateandexit.com. That's our a second
Love the
company that
name.
I own. It's all about transition planning. In fact, we're doing a webinar on tomorrow. Oh, it's tomorrow. Doing a webinar tomorrow with Greg Smith, who works at 1031 IPX, which is an intermediary for 1031s. And we're talking tomorrow for an hour about DSTs and 1031s, and then we're doing a podcast, which will be coming out shortly thereafter too. So elevateandexit.com and then libertaswealth.com, probably the best two places.
We'll put both of those links in the show notes.
Sure, that'd be great.
Adam, thank you so much for coming on the podcast. It's been absolutely a blast. Thank you.
No, same here, Sharad. Thank you so much for having me on.
We hope you enjoyed today's episode. If you like a second opinion on your retirement plan or investment strategy, please head over to libertaswealth.com. This podcast is for informational purposes only and should not be considered as legal, financial, tax, or as a basis for investment decisions. Always consult a certified financial planner or a fee-only fiduciary advisor before acting on any ideas discussed.